Welcome to the B.F. Anderson Technical Report for April the 1st. We're doing this on a Wednesday just to get it done during the middle of the week. I want to remind everybody this is a great time to catch up on any financial reading that you would like to do. If you go to our webpage, we have a list of very good books, and would be a good idea while we're all at home and kind of catch up on something interesting. There are some very interesting financial books that read like novels, actually, and they're somewhat adventure stories. All right, let's get on to what we need to do. Now, we got a lot to cover. I'm going to move fast. Now, trend following, remember the term or the saying, the trend is your friend. All right, I have been using trend following for many years, and thank goodness I have been, because it's really helped me greatly get through these bear markets, and we are in a bear market. Our firm is heavy in cash right now. We've taken a very defensive position, and so far so good. So the main thing is, how are we going to get reinvested? Well, that's just going to be a process. It's going to take some time, to be frank with you. So let's get started. Here's the NASDAQ daily graph. Moving average is turning down. Index is kind of breaking down again today. We're not seeing it. It got up to the to the 25-day moving average, kissed it, and then pulled back. So basically, we're still seeing a problem market here. NASDAQ on the weekly basis. Now, this is your 35-week moving average. It is now peaked. It is turning down, and we are in the fourth week of being below that 35-week moving average. Remember, the sell signal on this indicator comes when you spend 2 weeks below the 35-week moving average. And I can tell you, just about every bear market I've gone through, this is exactly what happens. Now, let's go fast here. Here's global Dow. Avoid global stocks. Doesn't look good. Downward momentum, very negative. Small caps, same story. In fact, the small caps, I'm really paying attention to the small caps, because they have been, in my opinion, one of the best leading indicators out there. Everybody's following the Dow Jones, everybody's following the S&P, everybody follows the NASDAQ. I'm just telling you, pay attention to the small caps. Trends are not good. Big time momentum, and this is our basically second month of downward momentum. This is a monthly graph. We're on a death cross on the small caps. Now I'm gonna catch myself here. Yeah, we are on a death cross. There's the 10-month crossing below the 20. Not good. Here is the S&P 500. Same basic story. A lot of downward momentum, but the S&P is still on a golden cross, but rolling over. Value line geometric. Now this is another one very similar to the small caps. Let's see here. We've got the 10-day crossing below the 20. Therefore, we're on a death cross and bad momentum. So keep your powder dry and don't chase high dividend paying stocks, because you need to understand the dividends come from earnings, and if earnings dry up, they'll cut the dividend. We're already seeing a lot of dividend cuts out there. Just don't do it. Now here's the Golden Dragon, which is all the Chinese stocks that trade in the United States. These are high-quality Chinese stocks. However, we have now gotten a death cross on it. Momentum was starting to look a little better, but now it's breaking down. Stay clear pretty much of everything, to be honest with you. All right, here's the aggression index, where we're taking a ratio of technology stocks represented by the NASDAQ, comparing it to consumer staples, things like Coca-Cola, Anheuser-Busch, that kind of stuff. Toothpaste, toilet paper, that kind of thing. So you can see here, when the line is going up, it's telling you that technology stocks are outperforming the staples. Well, when the line goes down, it's telling you that the staples are outperforming technology, and that means that people are not aggressive. The risk is off. So basically, it broke below that moving average, tried to get back above it, and is breaking down again. Continue to be cautious. Now, here are the three economic factors we're looking at. This is the yield on the 10-year Treasury note. See, it's basically close to making another new low. As of right now, we're at 0.63, which is unbelievable low. Now, West Texas Intermediate crude oil continues to drop, broke below $20 a barrel this week, kind of holding there. But this is what I'm hearing up in North Dakota, New Mexico, and in Texas, People are selling. You see, this is a contract price. This is the futures market. However, if you just do a regular buy, just a buying of oil, they're selling it for as low as $4 and $5 a barrel because they can't store it. And nobody wants it even at that. So here are the small cap stocks. Again, very strong downtrend. Tried to rally, not rally. And small caps are important. It's kind of telling you, keep your powder dry. Now, on the put-call ratio, okay, we got real bunch of fear in here. It's starting to kind of normalize. I'm going to talk a little bit more later in the video about this indicator. It's a very difficult indicator to use because you've got to use it as a secondary indicator. Don't make buy and sell decisions in your portfolio based on this. Just kind of confirm what your trend following indicators are telling you. The trend rules. That's the best thing. Remember, the trend is your friend. Now, as we look at the 200-day moving average, we're also at the top here. This is the S&P. This is the S&P. You can see what's going on here. We broke down, tried to make a low. We made a low. We're trying to rally. Now we're pulling back again. But until we get back above that 200-day moving average, I would really say we're probably in a bear market. And it'll all start when you see us get above the 25-day moving average and it turns up. That's what we're waiting for. We'll talk more about that right now, in fact. Now, if you're sitting on a lot of cash, like we are, and we want to nibble a little bit, but we're going to be very patient here. We're going to move very slowly, okay, because this is a bear market. We're probably going to retest the lows, may even break below them, so just be aware of that. The way I would recommend you try to do this is the 10-day moving average on the S&P, this is the 25-day moving average, and this is the 50-day moving average. The way I would do it, I would divide your cash up into three parts, like a three-legged stool. And the first leg of the stool would be if I'm above the 10-day moving average and the 10-day moving average is moving up, I think I would work at the concept of getting maybe 30% of the money in, 1/3 basically. Then if we get a bull market going or we put in a bottom and we start to see a break above the 25-day and it turns up, maybe then put in another third or just start working it in. I'm going to show you some ideas here in a minute. Now, this is interesting. This is what we call the VIX. This is the volatility index. Now, I go back 20 years on this, and I can tell you I can go back to the very beginning of the VIX, and you're never going to see much like this. This is a reading of around 80 on the VIX. These are record high readings. This is where we are now. This is what we just hit in the last couple of weeks, last month. So we're getting readings that are incredible. This is volatility. This is telling you this market is volatile. Now, this is somewhat of a sentiment indicator because it's really showing you a lot of fear here. In fact, the VIX is called the fear index. So I think it would make sense to go look at 2009, which is when this happened, and see what that bottom looked like because it might be similar. You just don't know. You know, Warren Buffett says history may not repeat itself, but it sure rhymes. Anyway, the way I would do this and the way I would watch this bottom is that we don't know if it's a V bottom or a W bottom or, you know, like this. This is a W. See W? So, you know, we get extreme fear. Like right here. Now I've got here the put-call ratio right here, which is measuring fear. We're getting extreme fear here at this bottom, okay? So usually you get extreme fear, and then you get less extreme fear, and then you get less extreme fear, and then you put in the final low, okay? So the way I would look at this is use trends, use the moving averages. They're very powerful tools. So I would only consider getting back in the market in a serious way is if we start to get above this 25-day moving average, just like we did back here. Now, you popped up above the 25-day, which was somewhat of an anemic buy signal, and you might have nibbled a little bit in there, but I'm just telling you, then we turned around and we made a lower low. So this could be where we have been recently, and then we're going to make another low. So we could retest here. More than likely, that's going to happen. Need to be aware of it. So this is where we are right now, just to kind of show you the same concept here. Okay, what I've got here, this is the 10-day moving average, this is the 25-day, and this is the 50-day. Now, this is the put-call ratio, so you can see the little bit of difference here. We got the extreme fear a little bit in advance of that absolute bottom. You know, this is the bottom so far. So what we're going to have to see here is that if this low holds or not, because if the market continues to break down and break below that low, we're going to basically have a double bottom and a retest. Now, kind of, you know, you can say something like this. You could say it's a stock market or it's a market of stocks. And I prefer to view this as a market of stocks. I look for stocks. I'm a stock buyer. I'm a stock guy. I pick individual securities. I don't want to be in a mutual fund. I don't want to commingle my money with other people because there's just too many disadvantages to doing that. But a lot of people like the mutual funds and, you know, go for it. Anyway, here's Microsoft. So you can see here this was, if we go back and, you know, we look at what happened back here in '08, and this low here, I'm matching up actually here. Okay, so here's your initial low in the market, and then you made your second low, and then off to the races. But you notice here that Microsoft never really gave a buy signal of any kind during this period. It didn't give the buy signal until that second low was made. Now, if we look at another stock like Apple, you know, these were stocks that back in '08, '09 probably made a lot of sense. So you can see here with Apple, you know, you get the first low in the market. You really don't get much of a buy signal in here. It's just kind of drifting sideways, no trend whatsoever. Then you get the second low, and then you pretty much take off, but then you kind of go through a little bit of a third low, and then realize that if you waited for the moving averages to cross and to give you the buy signal, you were buying Apple at $12 a share, which would be a pretty good deal. Now, here are the top 5. These are the 5 stocks that are in our database that we're looking at that are the strongest stocks in our database. This is DocuSign. They're very much involved in, you know, legal documents where you can do it all over the internet. Therefore, if you don't want to go to your, you know, a closing on a piece of real estate or whatever, you can just do this all remotely, and with the virus kind of makes sense. But you can see here the 10-day has broken above the 50-day. The stock is looking strong. In fact, this is what you call a gap up buy signal. See this volume down here? The stock normally trades 2.8 million shares a day. That day it traded 7 million shares on a gap up, which told you that the big money was moving into this thing. Here's Dexcom. Now, this is a medical company involved in diabetes. They make glucose monitors. Looks good. But, you know, we haven't gotten that cross yet where that 10 days coming above it. I'm not going to look at that. Moderna. This is a company that's working on a vaccine for the virus. They're one step ahead of Johnson & Johnson, who's also working on a vaccine. But, you know, it's acting okay. Keep an eye on it. Like I say, not buying a whole lot right now, but just keep an eye on these things. This is one we do own. This is one of the few stocks we do own. I want to make a note about this. This company, Regeneron Pharmaceuticals, they have got a pristine balance sheet. They've got over $3 billion in cash. They have less than $1 billion in debt. They're making money. They got some really successful drugs, and they're working on treatments for the virus. But notice how smart the market is. It basically, you know, we got this big drop. You know, this was when the big drop came. This stock held above the 50-day moving average very nicely, and then is now breaking out to the upside. All I can tell you is we own the stock, and you would be very hard pressed to find a stock that has held above the 50-day like this during that drop. So just be aware of Regeneron. I think they got something. Vipshop Holdings, this is a Chinese retailer. Just something to be aware of. The China stocks are kind of popping up, so just be aware of that. Okay, well, look, thanks for all your patience, and have a good day. Hopefully we get through this period, and I hope everyone stays real safe and healthy. Let me know if you have any questions.